So you know what a student loan is, but you're still fuzzy on the mechanics. How does the money actually get from the lender to your school? How does interest really work? And why does your balance sometimes seem to grow even when you're not in school? And what's the deal with all these different repayment plans? If the entire process feels like a black box, you're not alone. The student loan system is a complex machine with many moving parts, and most people only see the input, which is getting the money, and the output, which is decades of payments. But understanding what happens in between is the key to mastering your debt and saving thousands of dollars. This video is your operator's manual. We're going to walk through the entire life cycle of a student loan, from the moment you apply to the day you make your final payment. We'll demystify the confusing terminology, show you exactly how interest can work against you, and reveal the insider strategies that can help you pay your loans off faster and for less. This isn't just theory, this is a practical guide to the financial instrument that will likely be one of your biggest lifelong commitments. Let's open up the engine and see how it all works. The process begins with the FAFSA, the free application for federal student aid. This isn't just for grants, it's your gateway to federal student loans. You fill this out every year, providing financial information for yourself and your parents. Your school's financial aid office then uses this data to put together a financial aid package. This package will outline any grants, scholarships, work-study opportunities, and the types and amounts of loans you're eligible for. This is your first major decision point. You'll see offers for direct subsidized and unsubsidized loans. It is absolutely critical that you understand the difference between these two, because it will fundamentally change how much you owe in the long run. A subsidized loan is the best deal you will ever get in the lending world. It's available to undergraduates with demonstrated financial need. The magic of a subsidized loan is that the U.S. Department of Education pays the interest on your loan while you're in school at least half-time for the first 6 months after you leave school and during any period of deferment. This means the loan balance you take out is the balance you have when you enter repayment. It does not grow while you're getting your education. An unsubsidized loan is available to both undergraduates and graduates, regardless of financial need. The catch is that interest starts accruing, which means building up, from the moment the money is sent to your school. You are responsible for all of that interest from day one. If you don't pay the interest as it accrues, it will be added to your principal balance when you enter repayment, a process called capitalization. This means you end up paying interest on top of interest, and your total debt can grow significantly. The pro tip here is simple: if you have a choice, always accept subsidized loans first. If you haven't subsidized loans, try to pay the accruing interest while you're still in school, even if it's just a small amount each month. This one habit can save you a surprising amount of money. Once you accept the loans in your financial aid package, the funds are disbursed. This means the money is sent directly to your school to cover your tuition, fees, room, and board. This usually happens at the start of each semester. If there's any money left over after your school bills are paid, the business office will issue you a refund. This refund is not free money. It is part of your loan, and it will accrue interest just like the rest of the balance. It's meant for education-related expenses like books, supplies, and transportation. The biggest mistake students make is treating this refund like a windfall. Be strategic with this money. If you don't absolutely need it, the smartest move is to give it right back to the lender to pay down your principal before interest can capitalize. This is like giving yourself a guaranteed return on investment equal to your loan's interest rate. Now, let's talk about the most misunderstood part of the process: the in-school period, grace period, and repayment. While you're in school at least half-time, your loans are in an in-school deferment. For subsidized loans, this is a free pass. For unsubsidized loans, the clock is ticking on interest. Then, after you graduate, drop below half-time enrollment, or leave school, you enter a 6-month grace period. This is a buffer designed to give you time to find a job and get financially settled. Again, for subsidized loans, no interest accrues. For unsubsidized loans, interest continues to pile up. At the end of that 6 months, repayment officially begins. This is when capitalization typically occurs for all the unpaid interest that has accrued on your unsubsidized loans during school and the grace period. Your loan servicer, the company hired to manage your loans, will contact you and automatically enroll you in the standard repayment plan, which is a 10-year plan. But you have options, and this is another critical decision point. The federal government offers several repayment plans, and choosing the right one can make your debt manageable or set you up for financial stress. The standard plan is 10 years, and you'll pay the least total interest over the life of the loan. But the monthly payments can be high. There are extended and graduated plans, but the most important for many borrowers are the income-driven repayment plans. These plans, with names like Repay, Pay, IBR, and ICR, calculate your monthly payment as a percentage of your discretionary income, usually 10 to 15%. If you have a low income, your payment could be $0. Now, here's the catch with income-driven plans: they extend your repayment term to 20 or 25 years. While this lowers your monthly payment, you will likely pay more in total interest over the life of the loan because you're taking longer to pay it off. However, at the end of that 20 or 25-year period, any remaining balance is forgiven. This is a huge benefit, but it comes with a potential tax consequence, as the forgiven amount may be considered taxable income in that year. For people working in public service, there's also public service loan forgiveness, which forgives your remaining balance after just 10 years of qualifying payments, and this forgiveness is tax-free. Understanding these plans and how they interact with your career goals is essential. If you're going into a low-paying public service career, an income-driven plan aiming for PSLF might be perfect. If you're going into a high-paying corporate job, the standard plan will save you money on interest. The entire system is designed to be long-term, which is why the impact of interest is so powerful. A little bit of interest, compounded over a decade or more, can turn a $40,000 loan into a $60,000 repayment. That's why strategies like making extra payments, even small ones, early in your repayment term can have an outsized impact. Every extra dollar you pay goes directly toward the principal, reducing the amount that future interest is calculated on. This is called amortization. In the early years of repayment, the majority of your monthly payment goes toward interest, not principal. By making extra payments, you flip that script and start chipping away at the principal balance faster. The key to making student loans work for you, instead of against you, is to be proactive, not reactive. Understand the terms before you borrow. Choose your repayment plan strategically based on your income prospects, and if you can, pay more than the minimum. It's a marathon, not a sprint, and with the right knowledge, you can cross the finish line without being crushed by the weight of your debt. Before we finish, a critical disclaimer: I am not a licensed financial advisor or student loan expert. The information in this video is for educational purposes only. Student loan programs, interest rates, and forgiveness plans are complex and subject to change by Congress and the Department of Education. You must always consult the official government student aid website at studentaid.gov and your assigned loan servicer for the most current information and for advice specific to your individual financial situation. Borrowing for education is a major decision with long-term consequences. So please conduct your own thorough research.